Look at the volatility of Bitcoin here. From a trader's perspective, isn't this really exciting? But I tell you what, from a mining perspective or a business owner's perspective, where you're exchanging cryptocurrency for goods or services, this is an absolute nightmare. And what we're going to talk about in this video is derivatives, who they serve, what the purpose is, and then we're going to spin into how you can make money as a trader with derivatives. We're going to talk about the bare bones, the basics, the fundamentals. We're going to cut away all the noise so that we can take what's very complex and make it very, very simple. Let's get into it. So I'd like to thank Victor from Quedex for sending me a link to a presentation he did. It really inspired this video and it's a great presentation. I'm going to put a link to it in this video, so definitely go and watch that. But what we're going to cover here is what are derivatives really and who uses them and what purpose do they serve? So let's get into that. So the first question is, who uses derivatives? Now let's think about a Bitcoin mining company, for example. The price of Bitcoin going down is a big threat to a mining company. You want prices to go up because the more Bitcoin that you're making and the higher the price to the dollar, the more money you're essentially making. Now let's think about this example from an online store where you could be getting paid for a service or a product that you're selling or serving to the market, and you're getting paid in Ethereum or Dash or Bitcoin or whatever you're getting paid in. Price volatility is a big risk. It's a big problem for you. And so what you want to do is make sure that you can keep prices in crypto consistent, but not risk losing your money in a situation where volatility just goes through the roof. Say the prices of crypto are absolutely bombing and all of a sudden your profits have halved or you're making a loss. That makes no sense. So you really need to hedge your position if you are exchanging goods or services for crypto, or let's say if you're a mining company and you want to make sure that if the prices are going to tank, that you are well protected. It's like buying insurance against that price movement. Okay, so what actually are derivatives? And I'm going to talk about this in very simple terms. Now, anyone can understand it. If we think of Bitcoin, Bitcoin is the underlying asset. Bitcoin is an asset. You can own Bitcoin. I can buy Bitcoin. If the price goes up, I can sell it and make money. If the price goes down, I can sell it and lose money. So I can own the underlying asset of Bitcoin. But what if I was to tell you that I would agree to buy, say, 10 Bitcoin from you 1 year from now at a determined price on a determined date, and I would be obligated to do that? Well, if that's the case, then you as a seller will know that up until a certain date, you will always be able to sell Bitcoin at a certain price. And this is going to be very handy for you if you're, say, a miner. What I've just described here is basically a futures contract. Now, I know that I've done extensive videos on futures and options on this channel, and I will link to some of those. Now, an options contract is very similar. The only difference really is that there's no obligation to buy or to sell. I will have the right, or you will have the right, depending on who's selling and buying the contract, but there is no obligation. So these are two contracts. Now, I want you to think about this for a second. If the price of Bitcoin moves up or down, the value of these contracts moves up or down, and you can make money or lose money on the movement of the value of the contract and not just Bitcoin itself. So a derivative is just that. It's a derivative of the underlying asset. And typically it's going to be a contract between two parties that is binding. So you will have the right and not the obligation to buy or sell an underlying asset, or you will have the obligation with futures to buy or sell an underlying asset. And that's what these do. Now, one of the interesting things about this is they give you something called leverage. Now, in trading, a lot of exchanges try to encourage you as a trader to trade with a lot of size and leverage, meaning that for every dollar the price of Bitcoin moves, your profit could be 25x that, or your loss could be 25x that, but they don't really tell you that. When it actually comes to money management, trading with a lot of leverage, actually, in my opinion, really doesn't make sense at all. It's a very fast way to lose all your money. However, if you think about it as a business owner where you're holding Bitcoin, leverage is very useful because now it can become like insurance. You can buy a contract for very cheap, and for every dollar that the price moves against you, you are protected. And yet it only costs you this. Typically that would be called the premium of that contract. So these contracts are very, very useful. Now, from a trading point of view, you can make money off these contracts. And that is the key takeaway from this video. That's what you need to understand. You can make money through arbitrage with these contracts, and you can make money through speculation with these contracts, and you can even make money just trading volatility. Let's go back here a second. When we look at volatility, imagine if volatility is down here, so it's at the bottom. If I was to tell you to predict between now and the next year on whether you think volatility will go up again, what would you say? It's a no-brainer, right? If volatility is very, very low and you can just trade this volatility, it's obvious that volatility is going to go up again and you can make money from that. Now, how cool is that? So it's very, very important that you understand with derivatives, you can make money even just trading volatility. Also, you can make money no matter which way the price moves of the underlying asset. One other thing to note is that the introduction of these derivatives actually lowers volatility over time. You can see the trend in Bitcoin volatility actually going down. And this is something I found very fascinating. I didn't know this, and I found it fascinating from watching Victor's talk. So I'll make sure again that I'll link that in this video. But this is fascinating to me. So the actual introduction of futures contracts, of options contracts, helps businesses, mining companies, etc. It helps them protect against price movement, and it actually has an effect where it helps to decrease volatility over time for that underlying asset. So very interesting stuff. In the next video, we're going to talk about options payout and a little bit on put call parity arbitrage. So with no further delay, we're going to get into that. I hope you got a lot of value from this video. If you've got any questions, always put them in the comments. See you guys in the next one.